I'm the founder of Holland Advisors. I set up the Holland Advisors Equity Fund in 2011 and we converted that fund to a UCITS fund in 2021. Over the last 3 years the fund is up 48%, which is against the comparator, which is up 18%, which is the IA Global sector. The fund is also ranked top quartile over 1, 2 and 3 years by Citywire and TrustNet. If investors thought about when they were making an investment what they would do if they were buying into a local business, I think they'd think a lot more clearly. So for example, what is the business model of that company? Is it a good business model? Has it got growth? Has it got stability and sustainability in that business model? What's the manager of that company like? Have they got integrity? Are they proven? Have they grown the business strongly over a long period of time? And are their interests aligned with yours as a potential shareholder? And then finally, what valuation are you paying for that business? Are you paying a fair value for the business in comparison to the potential it's got for its growth in the future? And if you are paying a fair value for the business, then that's a reasonable assessment of those 3 factors. That is exactly the way that we look at buying into quoted shares, and that is exactly what our investment approach is. So our investment objective, simply put, is to compound our investors' capital at the best rate we possibly can. An equity investor that compounds at 10% per annum over 20 years sees his capital rise to a multiple of about 6 to 7 times his initial investment. Another equity investor that sees his investment return at 5% per annum only sees his capital over those 20 years grow to 2 to 3 times his initial investment. And sadly, those two in comparison with each other show roughly the returns made by equity indices, i.e. 9 to 10% per annum in the US index, let's say, for the last 10 or 15 years, versus the actual return that's been made by investors of more like 5%. The difference of the two comes down to the fact that equity investors are often overcommitted to investing at the peak of the market and not investing enough or too skeptical at the trough of the market. And that's why they make a 5% return, whereas an index might rise by 10%. So what we're trying to do is compound investors' returns at better rates than that. We think if we follow a very disciplined approach, we can compound investors' returns at more like 15% per annum. So how might we do that? The way we would do that is, in shorthand, standing on the shoulders of giants. And by that I mean copying what the great investors have done in the past by investing in great companies that are run by great managers, entrepreneurs, owner-managers, call them what you will, and investing when they're offered at great prices. So the essence of our investment approach is to try and buy great companies when they're priced like bad companies. That's an easy thing to say, but it's quite a hard thing to do. In our view, many investors either buy cheap companies, but often those cheap companies might end up being found out to be bad companies, or they buy great companies, but they might potentially overpay for them. And we want the best of both worlds. We want to buy companies that are growing and compounding and led by brilliant managers, but we want to buy them when they're cheap. And we've managed to do that with our sort of contrarian approach by buying businesses like Frasers, Meta and Amazon when their shares were marked down very heavily in recent years when we judge them to be really good quality companies. So buying great companies when they're priced like bad companies is the essence of what we do. It sounds easy, but it's not that easy in practice. It is, in essence, the North Star that we employ day to day in our business. To do that, we have to have conviction. We have to have conviction to know what types of companies we're looking for, know what entrepreneurs we want to back, but we also have to have the conviction to invest aggressively when those opportunities are offered to us. Warren Buffett famously once said that when it's raining gold, reach for a bucket, not a thimble. And that's what we try to do when great companies are offered to us at cheap prices. Holland Advisors only runs one fund, and all the best ideas we have go into that fund. The Holland Advisors team are the biggest investors in the fund, and as the saying goes, we eat our own cooking. So if you're a business-like investor and professional and long-term in your approach, feel free to get in touch with us.